August 5th, 2024, will be etched in financial history as a day of unprecedented turmoil. The events of this day will be analyzed and dissected by financial experts and historians for years to come as they try to understand the causes and implications of such a dramatic market collapse. Markets around the world experienced a dramatic plunge, sending shockwaves through every sector and leaving investors reeling. The suddenness and severity of the crash caught everyone off guard, from seasoned traders to novice investors. It was a day marked by panic, confusion, and a desperate scramble for answers. This wasn't just a dip or a correction, it was a full-blown crash, the likes of which we haven't witnessed in recent memory. The scale of the decline was staggering, with major indices losing significant percentages of their value in a matter of hours. The ripple effects were felt across the globe as markets in Europe, Asia, and the Americas all tumbled in unison. From the bustling trading floors of New York to the tech hubs of Asia, fear and uncertainty reigned supreme. Investors were glued to their screens, watching in horror as their portfolios shrank before their eyes. The sense of panic was palpable as people struggled to make sense of what was happening and what it meant for their financial futures. The question on everyone's mind: is this the beginning of a prolonged downturn or a temporary blip on the radar? Analysts and experts were divided, with some predicting a swift recovery and others warning of a prolonged period of economic hardship. The uncertainty only added to the anxiety as investors tried to navigate the choppy waters of a volatile market. The speed and ferocity of the decline caught many off guard. In just a few short hours, billions of dollars in market value were wiped out, leaving investors shell-shocked. The rapid descent was a stark reminder of the inherent volatility of financial markets and the risks that come with investing. Just yesterday, optimism seemed to be returning to the market after months of volatility. Investors were beginning to feel hopeful, buoyed by positive economic data and encouraging corporate earnings reports. The mood was cautiously optimistic as people looked forward to a period of stability and growth. Today, that optimism has evaporated, replaced by a sense of dread and a scramble for safe havens. The sudden reversal of fortune was a harsh wake-up call, reminding everyone of the fragility of the market and the importance of being prepared for the unexpected. As indices tumbled and portfolios bled red, investors were left grappling with the harsh reality of a market in free fall. The losses were widespread, affecting everything from blue-chip stocks to emerging market equities. No sector was spared, as the sell-off spread like wildfire, consuming everything in its path. The question now is not whether there will be further losses, but how deep the cuts will go. Investors are bracing for more pain as the market continues to search for a bottom. The uncertainty is unnerving as people try to gauge the extent of the damage and what it means for their financial well-being. This crash is a stark reminder of the inherent risks associated with financial markets. It underscores the importance of being vigilant and prepared, and the need for a well-thought-out investment strategy. The events of today serve as a cautionary tale, highlighting the dangers of complacency and the importance of risk management. It underscores the importance of diversification, risk management, and a long-term investment horizon. By spreading their investments across different asset classes and sectors, investors can mitigate some of the risks and protect themselves from the full brunt of a market downturn. While panic and knee-jerk reactions are understandable in such situations, they rarely lead to sound financial decisions. It's important to stay calm and avoid making impulsive moves that could exacerbate the situation. Instead, investors should take a step back, assess the situation, and make informed decisions based on a thorough analysis of the market conditions. Now is the time for calm, rational thinking and a reassessment of investment strategies. By taking a measured approach and seeking the advice of financial professionals, investors can navigate the storm and position themselves for a recovery. It's a time for careful planning and strategic thinking rather than panic and rash decisions. The road ahead is uncertain, and the aftershocks of this crash will be felt for months, if not years to come. The market will likely experience continued volatility as it grapples with the fallout from today's events. Investors will need to be patient and resilient as they navigate the challenges and opportunities that lie ahead. However, amidst the chaos and uncertainty, there are opportunities for those who are prepared. Market downturns can create buying opportunities for savvy investors who are able to identify undervalued assets and take advantage of lower prices. By staying informed and being proactive, investors can position themselves to benefit from a market recovery. By understanding the forces at play and taking proactive steps to protect their assets, investors can weather the storm and emerge stronger on the other side. It's a time for resilience and adaptability as people navigate the challenges and seize the opportunities that arise in the wake of a market crash. With careful planning and a long-term perspective, investors can turn adversity into opportunity and build a stronger financial future. The Japanese Nikkei 225 index, a bellwether for Asian markets, suffered its largest single-day drop since the Black Monday crash of 1987. This event has sent ripples through the financial world, reminding many of the fragility of even the most robust economies. The index plummeted by over 10%, wiping out trillions of yen in market value and sending shockwaves across the region. Traders on the floor were seen scrambling to make sense of the sudden downturn, their faces etched with worry and disbelief. The sheer scale of the losses has left many questioning the stability of the market and the factors that led to such a dramatic fall. This dramatic decline reflects the interconnectedness of global markets and the speed at which fear and panic can spread. In today's digital age, information travels faster than ever, and so does the contagion of market sentiment. Investors around the world watched in real time as the Nikkei's numbers tumbled, triggering a cascade of sell-offs in other markets. The 1987 crash, etched in the memories of many seasoned investors, serves as a chilling reminder of the devastating impact a market collapse can have. Back then, the crash was triggered by a combination of factors including overvaluation, program trading, and market psychology. The echoes of that event still resonate today as investors draw parallels and seek to understand the underlying causes of the current turmoil. While the current situation is not identical, the parallels are undeniable. Analysts are quick to point out similarities in market behavior, investor reactions, and the broader economic context. Both events highlight the vulnerability of financial systems to sudden shocks and the importance of regulatory measures to mitigate such risks. The suddenness of the drop, the sheer magnitude of the losses, and the sense of panic in the air are all too familiar. Investors, both large and small, are grappling with the implications of the crash, trying to navigate the turbulent waters of a volatile market. The psychological impact of such events cannot be underestimated, as fear and uncertainty often lead to further market instability. Japan, the world's third largest economy, is particularly vulnerable to global economic shocks. Its economic structure, heavily reliant on exports and manufacturing, makes it susceptible to fluctuations in international trade and demand. The recent crash has raised concerns about the resilience of Japan's economy and its ability to withstand external pressures. Its heavy reliance on exports and manufacturing makes it susceptible to downturns in international trade and demand. The interconnected nature of global supply chains means that disruptions in one part of the world can have far-reaching consequences. Japanese manufacturers, already grappling with supply chain issues, now face the added challenge of a weakened market. The current market crash, coupled with ongoing supply chain disruptions and geopolitical tensions, paints a bleak picture for the Japanese economy in the near term. The combination of these factors creates a perfect storm, threatening to derail economic recovery and growth. Policymakers and business leaders are now tasked with finding solutions to navigate these turbulent times. The Nikkei's plunge is a stark warning sign for investors worldwide. It serves as a reminder of the inherent risks in the financial markets and the need for vigilance. Investors must now reassess their strategies, taking into account the heightened volatility and uncertainty that characterize the current economic landscape. It highlights the fragility of the global financial system and the need for caution in these uncertain times. The interconnectedness of markets means that a shock in one region can quickly spread to others, amplifying the impact. This underscores the importance of robust risk management practices and the need for a coordinated response to stabilize the markets. As the dust settles, investors will be left to pick up the pieces and reassess their portfolios. The aftermath of the crash will likely lead to a period of reflection and adjustment as market participants seek to understand the lessons learned and implement strategies to mitigate future risks. The road to recovery may be long and challenging, but with careful planning and prudent decision-making, it is possible to navigate these uncertain times. Financial experts are already analyzing the data, looking for signs of recovery and potential opportunities. While the immediate outlook may seem grim, history has shown that markets are resilient and can bounce back from even the most severe downturns. Investors who remain calm and focused and who take a long-term view are often better positioned to weather the storm and emerge stronger. Governments and central banks around the world are also stepping in, implementing measures to stabilize the markets and support economic recovery. From interest rate cuts to fiscal stimulus packages, policymakers are deploying a range of tools to mitigate the impact of the crash and restore confidence. These efforts, while crucial, will require time to take effect and will need to be carefully monitored and adjusted as the situation evolves. On a more local level, small businesses and communities are banding together to support each other through these challenging times. The ripple effects of the market crash are felt not just in the financial sector, but across all areas of the economy. By working together and supporting one another, it is possible to build resilience and foster a sense of solidarity in the face of adversity. Education and awareness are also key components of navigating market volatility. Financial literacy programs and investment seminars can help individuals better understand the risks and opportunities in the market, empowering them to make informed decisions. By equipping people with the knowledge and tools they need, it is possible to build a more resilient and informed investor base. Ultimately, the key to weathering market storms lies in diversification and long-term planning. A well-diversified portfolio spread across different asset classes and regions can help mitigate risks and provide a buffer against market volatility. By focusing on long-term goals and maintaining a disciplined approach, investors can navigate the ups and downs of the market and work towards achieving their financial objectives. While the echoes of the 1987 crash reverberate through the financial world, they also serve as a reminder of the resilience and adaptability of markets and investors. By learning from the past and staying focused on the future, it is possible to navigate the challenges and emerge stronger on the other side. The road ahead may be uncertain, but with careful planning and a steadfast approach, there is hope for recovery and growth.
To learn more about gold IRAs, investing in physical gold, and the best reputable companies to do business with, please visit our website at givemethegold.com. See you soon.